Welcome to Investors Hangout once again. This is our fortnightly interaction brought to you by Aditya Birla Sun Life and Value Research. Today we are going to talk about what should a senior citizen's strategy be in these uncertain times. We are witnessing the greatest uncertainty in many years, where there are questions being, interest rates are coming down, deposit rates have come down. Inflation is low, of course, but I don't know what individuals' inflation is. It's very different from what we hear of, but that is how the financial system works. Inflation comes down, rates come down, and your deposit and interest income from deposits or fixed income investments, they also come down. Then there are also uncertainties about the way fixed income. We have had one or two small accidents. Then the equity market has also been very uncertain. Many investors started their equity investment or they have their accumulation in equity investments. They are getting nervous and scared of that, what happened in the month of March. Of course, from there on, we have recovered quite a bit. So what should your strategy be? And your personal circumstances. In your retirement, you become a little less sure of things. Your income has come down. You have stopped working, and you have worked all your life to accumulate something. So your being fearful is quite natural, quite understandable. With me is Mr. Rao from Aditya Birla Sun Life Mutual Fund. And I would like to ask him that what has been your experience? What are the kind of anxiety and curiosity or worry that you use? Are you also seeing a similar trend? And what exactly?
A week back, we just celebrated Senior Citizens Day. Maybe this episode is coming at a most appropriate time. In the last few days, I hear from them and a lot of concerns. I mean, some of them are my professors, some of them are my relatives, because people keep talking to me and people keeping asking me. In fact, my father-in-law is a retired civil servant, and he was talking to me and he said in 2000 he was getting 10% return on his bank deposit, and today he's getting 5.3%. It's a concern, it's every renewal it is going to come down, means it's a take home, his monthly income is coming down, and it's like this falling returns. There is a nosedive. It's challenging, and it has become for every senior citizen, it has become a matter of concern where to put my money, and the returns which I got a year before and what I am getting now is much lesser. What are the investment avenues available to me to invest now, and how do I restructure my portfolio? And these are the concerns which people are facing. For a senior citizen, there used to be an advertisement, TVC used to say, "Sir, utha ke jiyo." But now, how somebody has to keep his money to go up, and you need to look at what are those things. I leave these questions to you.
Yes, living with dignity, Sir utha ke jiyo is of course a very important goal, because that is what you have actually worked for a lifetime. There are serious challenges to it. One is the declining interest rate, because earlier things were simple. You retired, you had your accumulation. If you were getting your pension, then there was nothing much to worry. Even if you were not beating inflation, that was okay. If you were matching inflation and if you were not dependent on that for your income, it was okay. No, not any longer. Now the number of the percentage of population which has to really take, not too many people have provision of pension. That is one. You have to fend for yourselves, which means that you have to accumulate in your working years to the extent that it can support your income requirement in retirement when your income comes to a standstill. The other is there are some real issues, which is, of course, it's good news that you are going to live longer, and the bad news is that to have that Sar utha ke jiyo, living with dignity, you have to make sure that you are investing intelligently and you have the emotional quotient to deal with it, because if you have not if you don't deal with it very methodically, you run the risk of outliving your savings, which could be a calamity. So the only way to the principles which underpins which actually drives this whole approach, what you should be following is that one is in your accumulation years, make sure that you have little buffer. Having more is important. If by a fine calculation you need 60 lakh, I think you should make it rough and would try and endeavor to have 80 lakh. Having that buffer, that cushion, That margin of error is crucial. So plan liberally in your accumulation years. Of course, if you're done with that, if you're through with that period, the least you can do is, evaluate your circumstances. You just might have a pension. Get little conservative about your income requirement. Reduce your income requirement as much as possible, because there will be some contingency coming your way. It's your money, you have to preserve it. So the real principle which drives it: beat inflation and consume what you are earning over and above inflation only. The rest of the money should lie there, because your money should be able to support you at all times. That is the only way you can actually eliminate the risk of outliving your savings in your life. That's one. The other is that, many a times your need for regular income. We actually lose track of, the longer term, what happens 10 years from now, 15 years from now. Many people who get their superannuation benefits, all their life, they have not been used to dealing with the scale of money which they get at a time. So you normally have this sense of having enough or having plenty, but it may not be enough or plenty, simply because you haven't experienced that. Because the biggest gap that is going to happen is you are not going to get your salary check from there on. If you are 60 and if you get 80 lakh rupees as a result of all your accumulation or your provident fund, everything that has been accumulated, don't feel happy about it. Do a calculation. Of course, there is reason to be happy about it, that you have been disciplined, it has accumulated, it's good news. But don't feel happy in terms of that, now you are in the splurging mode. Because if you're earning 40,000 rupees a month and suddenly you are settled with 80 lakh rupees in your bank account, the risk of this sense of being wealthy, but you may not be, because this 80 lakh rupees is so crucial that it has to support you for next 20 years, 30 years, 35 years through all medical. That is all that you have. That is your job. That is like your income. So it is going to support that income. So you need to be extra careful. At the same time, becoming extra conservative because you are old is not the way to go. Because if you become conservative, you will get safe income, but your capital will remain constant, and that will not be able to support your income requirement in future. So you will have to embrace equity. You will have to learn. You will have to build your belief. You will have to look for an advisor. You will have to look for somebody who will tell you that what this beast is, because this animal called equity will remain like that. It will be volatile. It will be scary. But how to deal with it? And the dealing with it is very simple. Have an allocation, maybe 15%, 20%, 25%, 35%, depending, and it requires careful planning. Where your fixed income should be invested, which can support your needs, and these are circumstantial. If you have a pension, then you need less income from your investment. If you have a rental income, you less income from your investment, and so it has to be very much tailored to your requirement. Investing in equity, how to go about doing it, how not to panic, because managing your temperament in difficult times is the only way to scrape through it. Right now, there is a great disbelief that equity investment is risky. We have recently experienced that markets can crumble without a notice, and markets actually, move in a direction very rapidly when you least expect it. Sometimes they fall without a notice, and sometimes they surge without a notice. And the people who are able to withstand the urge to act on all such moves, and these are so unnerving that it is very difficult to do it. How to deal with it, how to configure yourself, unless you have a roadmap for yourself, unless you have little understanding of this, you really won't be able to manage this methodically. I would like to give a clear roadmap in terms of how one should go about doing it. These are broad principles, and these need to be tweaked depending on your circumstances or your situation, which means that if you have income and other things, so, your needs can change, so it can't be used. But say, for example, the first point which everybody should keep in mind is that what you need in the next 1 year. If you are going to be completely dependent on your investments for income, just keep it in a liquid fund or keep it handy. Maybe 2 months income in your bank account and 10 months income in your liquid fund, and you move that money from liquid fund to your bank account as and when on a monthly basis. So you are effectively getting your salary. And that money should be in liquid funds simply because it's relatively safer, it's not unpredictable, and you will never have this anxiety that what happens now, what happens this month for your consumption. Then, the next 2 years income should be in, short duration funds. They will yield little more return, they will be liquid, and you'll be able to move it. And once again, once you have consumed your your money in the liquid fund, move 1 year's money from the short duration fund to the liquid fund. So it might sound complicated, but it will require, very few transactions. Once every year from the short duration fund, and every month redemption from the liquid fund, which you can do with an online app. So it is eminently, possible without much of a friction, and with great ease, simply because an app can also do it, and get used to it. This will save you time, this will save you anxiety. And mutual fund, one thing which has not been talked about in great detail, that it's very convenient and relatively safe, because all the money comes directly to your bank account. You don't have to wait for the check, which used to happen before. The money doesn't get lost. The transaction times are prescribed, so it hits your bank account, and this is very crucial for this kind of money which is invested. Typically, for your money to be able to protect its worth, I'm saying minimum, something like 25 to 35% of your money should be invested in equity if you are going to invest, if you are going to depend on your investment for income. For example, because if you don't do it, your capital which is lying there, which is generating the income, will lose its potential to preserve its value. If you have 10 lakh rupees now, the 10 lakh rupees is not equal to 10 lakh rupees 5 years from now or 10 years from now, that the worth of that 10 lakh rupees will get reduced. So it is also important. So just generating income from your investment is not enough. The ability of your capital to protect its worth, its purchasing power, is crucial, and for that you need equity. Now, equity is risky. How to deal with it? Diversify and don't invest at one go. These are two basic rules which you should be following. Every year, move your money, when as and when the equity does well, to the short duration fund and the liquid fund, because whenever it does well, and make sure that your overall withdrawal rate is not exceeding 4 to 6% of your total capital. If you do that, my sense is that if your investment generate 10% and it is 5-6% is the inflation, if you take out that much money, your money will also steadily keep growing up, protect its worth at the same time, and it will not happen precisely every year, and it need not, because most of the money is going to lie there, remain there. And just being careful about what you are withdrawing, what are you taking away, and what are you consuming, and resist the urge to tip into your capital for something which is avoidable. And this way, you effectively, the plan which I'm suggesting is a conservative one, because effectively you will have 3 years money of which you require will be lying in ultra safe thing. Remaining money, if it is in a portfolio, is a set of investments, which is 1/3 of the money is in equity, 2/3 of the money is in fixed income. That is also conservative. And if you take 6% of that money, I think one will be able to Geo for a lifetime. Mr. Rao, you also come across real investors. One is this plan which I'm suggesting. What is the potential of many investors following this closely?
Like most of the senior citizens I come across, because where the confusion coming, where the anxiety is coming, is there are many things which they are doing, many pockets they are investing. Probably how you can simplify among those buckets is the most important. As you rightly put it, it is like your retired investment is like when you are playing the cricket, it is like those 3 wickets you need to safeguard. And these 3 wickets are like your 3 buckets. The first wicket I need to get is my liquid funds, where the money which you said, it's maybe my 6 months to 1 year money, which is available readily whenever I need my necessity liquid funds. And the second, your 2 to 4 years money, which is giving a regular income. That is the second wicket. and the third wicket you need to safeguard is your growth wicket, which is the equity wicket. Probably if we can put these three buckets, people can simplify psychologically too. Like for example, if I mean it's true, equity is a asset class. There will be a period of time which can give a high return. There is a period of time which will give a low return. There is a period of time there is no return. But all these periods you can ignore, still you can play well, provided you know this bucket is for longer. I don't need to worry. And as you rightly put it, diversification is the key. Even you are safeguarding little more there. The most important is when you are getting a liquidity and then the regular income. Now only the challenge for any senior citizen is that it's like there are something external, something internal to them. The external challenge is your inflation, then the interest rates, then the market volatility. But internal challenges to them is their lifestyle and their withdrawals. Probably if you can realign these two, where I find a lot of confusion coming for them, and they feel panicky because there is something has come down. I was talking to a retired banker. I mean, he's my friend's father, and he says in January he got 55,000 is monthly withdrawal from the bank, which is his monthly income, and it has come down to something around 38,000, 17,000 over a period of 4 months, which is shocking to him. But incidentally, he got other money which he is not looking at. Probably my advice to senior citizens is look at in a holistic perspective, or have an advisor who can guide you on this, or put a diary where you can book these are the three buckets, and one bucket can become volatile. That's a volatile bucket. You just don't need to worry about it. Your liquid bucket, yes, instead of 4%, 6%, it may give a 4%. That's a structural change, and you get adjusted. But once then you can rebalance it. Your regular income, which has come down, do you need it? Or do you need to bring something from the equity to here, or vice versa? I mean, as Diren said earlier, if somebody is retired and is getting a pension, probably you need not worry about much. Probably you can look at a growth assets. All that you need to do is, this COVID has given an opportunity. It is a rehearsal for all of us, how frugal we can live and how you can realign your investment avenues. I was talking to someone day before yesterday, and it was about golden age. We call senior citizenship is a golden age, but the biggest thing I heard from this gentleman, he's a professor at IIM Bangalore. The golden age, you need to make that gold is truly gold. What is that gold? He gave a definition is it's the G starts, you need to gainfully employed. You doesn't matter, if you have a capability, you can always work in the current work from home scenario, whether you are 70, 75, you have a talent to work, you start working, you can be gainfully employed. And O is your money optimally invested. And L is your lifestyle, how you can upgrade or downgrade depending on the things, then you are most comfortable in a golden age period.
Lifestyle, okay.
And the last D is you get distracted with lot of news. Please don't get distracted. Bring the divinity, at the same time discipline of investments.
Great formula.
Yeah. And coming back to the questions, Dhiren, it's a very interesting questions. Here is a question coming to you from Mr. Parameshwaran. He says, how safe are secure debentures for a senior citizens? And what kind of credit rating would be safe while investing in a debenture of the assured returns? How do they compare with the debt mutual funds?
Secured debentures, they are, many debentures are unsecured. They're not, there is not an asset backing those debentures. As compared to that, there is a real tangible asset backing such debentures. But I would say that, err on the side of caution. All retirees should look at something which is no lower than, AAA or at most AA. But, AA, you don't have the capability of, trying to figure out. The problem of debenture is that it is easy to invest. And if all goes well, you get your interest on time, you get your capital back on time. But if something goes wrong, you don't get anything. And then there is a concentration risk. When you invest in a mutual fund, 2%, 4%, 5% of your money could be in a bond like that. Even they can go wrong. But if they go wrong, it is a small part of your money. Diversification becomes very useful when it comes to that. That there is one more thing, that when you invest in a debenture, you are tied to the whole tenure. You don't have the liquidity, interim liquidity of the kind which you have in mutual fund. Then there is a tax efficiency bit, that if you hold a debenture, if you hold a fixed income fund which is investing in such debentures, it becomes capital gains. When you invest in a debenture, all the interest income actually becomes taxable income for that particular year, or for all the interest that is accruing during the financial year. So these are the broad differences. If you come across, a great debenture which is available at a high yield, but a well-rated, high debenture with high rating, high credit rating, which means that it is relatively safer. The likelihood of getting your principal and interest on time is very high. The companies is of a kind, where the cash flows can support that easily. So it will not yield you very high return. So I think there are pluses and minuses of this. But if at all you like a debenture, make sure that its credit rating is the highest.
That's great, Dhiren. Dhiren is the next question coming from Mr. Utpal Datta. He says, I have invested 50% of retirement corpus in government guaranteed schemes like senior citizens and Prime Minister PMVVY and Post Office monthly income scheme. And the interest income generated from it sufficient for me to meet my expenses over next 6 to 7 years. The other 50% of the corpus is invested in aggressive hybrid funds. Should I move my money from the aggressive hybrid to short duration and book profit, or is there anything you can advise?
I would like to give him a method of booking profits. So he should think in terms of the 50% money which is invested in senior citizen savings scheme, post office, MIS, and PMBVY, which is run by LIC, which generates close to 7.5%. This is a great strategy, and if this can actually fulfill your need for income over the next 6-7 years, this is great news. You have done a very solid you have built a very solid foundation for your income. Now, the money that you have invested in these, they need to be supplemented in every 2-3 years. Maybe you are thinking of 6-7 years. Maybe that stage can come early. It is very difficult. I find it very hard to believe that your need for capital, for income, will remain constant, because these incomes will actually remain constant. It will remain constant over the next 6-7 years. Your expenses will not go up over the next 6-7 years. Assuming that I would be little more liberal with that expectation that every 2-3 years your income should go up in line with the inflation. With that in mind, the remaining 50%, which is an aggressive hybrid fund, they are good enough. These aggressive hybrid funds are one third of the money is in fixed income, is in equity. 2/3 is in fixed income. So this is all very conservative, and the capital which will grow here, maybe this will the incremental capital over inflation can actually go about supplementing the 3 investment that you have invested. Maybe there are upper ceilings to which you can invest. Senior citizen savings scheme, only 15 lakh rupees maximum you can invest, or Pradhan Mantri Yojana is 10 lakh rupees, or post office MIP also has a ceiling. So maybe those ceilings will go up in line with inflation in 3-4 years, and you can invest more there to derive more income. And this is that 50% which will make sure. So you are onto a good track. But there is one concern, that you will have to keep an eye on the aggressive hybrid funds. There are very few good options there, and they are not being evaluated purely on the basis of their performance many a times. So look for the character. There are 2-3 good aggressive hybrid funds. Be careful with your selection, because this is a very important money. Even though you do not depend on the income from these funds, it is very important, because these are the funds, the performance their performance is going to really ensure that you will have, they will be the only ones which will supplement your income requirement in future.
That's great. This is a question from Mr. Megsham. Should we opt for dividend option of the mutual funds to get a regular income? Probably SWP could be better, I feel. Dhiren, what do you suggest?
Yes, one is that I would like to demystify that dividend from mutual funds is not a great yardstick for you. Mutual funds give dividends, but it doesn't mean that it is performing. Performance of a mutual fund is something which is most crucial. Many a times, if you invest today in a mutual fund, and if the mutual fund gives a dividend of something like 10%, which will be on the face value, you might feel happy about it. But it is effectively your money coming back to you. The principal might go down in value simply because the fund paid. Mutual fund will pay dividend at a time of the quantum and time of their choosing. Don't do that. Simply because, one, it is not very efficient. The other is that it is not very much in line with your requirement. The right way of deriving income or periodic withdrawal is the systematic withdrawal plan, because one, it is tax efficient. Second, it is customized to your requirement, because you will be choosing the amount and the period or when you need it. Assuming that you get your pension and you have 15 lakh rupees to be invested in a mutual fund, would you like to get that annual dividend, or would you like to have that, every quarter you need something like 15,000 rupees every quarter? Will that do your job? Will it be meaningful, or will it serve your purpose? Do that, and that can be done. It is more tax efficient because in the initial years you are taking the money. A good part of it, optically looks that you are getting your money. You are getting the return. You might be taking your return, but tax-wise it looks like withdrawal of capital, and on that you don't have to pay any tax. So it's tax efficient. It is methodical. It is very much customized to your requirement and the quantum and time. So go for systematic withdrawal plan, and it is very easily implemented. It is almost like a standing instruction you give in a bank.
Here is a very interesting question, and this is from Duka Haran Mukherjee. Mr. Mukherjee is asking, how can I guess the future rate of inflation and the household expenditure? And I am, of course, 10 years away from the retirement. Probably Mr. Mukherjee should, the inflation of the last 10 years, last 30 years, we can see extrapolate is one part of it. And household expenditure is all depends on individual family choice, and it's one he has to make it out. And but therein I would like to ask this question: do you see any ballpark number? And I'm not very sure. Most of our retirement plans based on various assumptions, and all these assumptions may come appropriate or may come true or may not come true. But you need to keep prepared. Probably he is 10 years from the retirement, but after that another 30 years or 40 years that money need to be there, and inflation keeps changing. What is that your advice on this?
My guess, my honest suggestion is that you can't guess. You can't guess for a variety of reasons. One is that the core inflation which the government discloses itself is not your inflation, your household expenditure. You have a certain lifestyle cost which you can predict. The flexibility of changing your lifestyle is only you can predict. There are things, which it's a very personal thing. For me, there are certain expenses, there are certain lifestyle, certain things I'm used to on which I spend money. I would think that, it is extremely important for me. I can't do without them. There are other people who might think that this is an expense which I can do without. I don't necessarily, if I have to discontinue this expense, it won't be a great deprivation. So you are the best judge. And then little imagination where I think, what has happened in the past could be an indicator that you will be getting surprises. You'll be getting surprises in terms of healthcare cost. You can safely, guess your health conditions or your lifestyle, which can be a pointer to your health conditions in future, for which you need to prepare. But any kind of preparation will not be enough because we come across so many. So I think there is another way of looking at it. Because you are 10 years away from retirement, one is to plan liberally. Have a very high cost of inflation, factor in high inflation or high, supporting all the income, and focus on income right now, focus on investments right now, focus on savings right now, because you are 10 years away from retirement. If you do that, you will have the margin of error. That is what I was telling you in the initial discussion, that if you need 80 lakh rupees by a very precise calculation in your retirement, provide for 1 crore, provide for 1 crore 20 lakh. That is the margin that you should have, because and you might get lucky. You may require less. That is a very happy situation to be in, as compared to with your fine calculation. If you end up at the time of your retirement that you have barely enough, then you have to really pray and make sure that, and be lucky. I don't think we should be, dependent on prayers and luck.
And here is a question from Mr. Manoranjan Mahapatra. He says, I am 7 years old from 7 years away from my retirement. Should I invest in small cap funds?
If you're investing for 7 years in a small cap fund, it's a good idea. If you're going to retire in 7 years, the date of retirement is not something where you have to really, small caps become untouchable or something, equity becomes untouchable. In fact, you have to embrace it. And if you have 7 years time, you will get used to it. You will understand, because, most of these risks, they are real risks if you don't have time. And they are not at all a risk if you have time. And if you have 7 years to your retirement, that doesn't mean that you have to take all your money which is invested in equity and put it in fixed income. Even in your retirement, the money should be lying there in small, should be in equity. If you get used to higher return of equity, and if you have experienced it, that how to deal with it in your earning years, you will be better able to withstand that. Thank you very much for following what we have been saying and embracing it. And I hope that, if you plan things or if you go accordingly, I wish you very best that you never outlive your savings. Thank you very much for joining us. Come back again, a fortnight from now.
Thank you so much. Thanks a lot.